It is amazing to me that Chairman Powell and the Fed governors, as you mentioned, there are no Fed governors here in the Bitcoin ecosystem, but there are in the United States. And every time one of them speaks, markets move.
In the world of finance and investment, few voices carry as much weight as Cathie Wood, the CEO and CIO of ARK Invest. With a keen eye for disruptive technologies and a knack for deciphering market trends, Wood's insights are eagerly sought after by investors worldwide. In this comprehensive analysis, we delve into a recent video where Cathie Wood shares her expert perspective on monetary policy, inflation, and the global economic landscape. Cathie Wood kicks off her discussion by highlighting the disciplined nature of Bitcoin's monetary policy. Drawing from a recent brainstorm session with miners, she emphasizes the elegance and simplicity of Bitcoin's code-driven approach to monetary regulation. In contrast, she presents a chart illustrating the fluctuating growth rates of M2 money supply over the past 4 decades, noting periods of double-digit inflation and the impact of monetary policy shifts.
This halving chart is, you can see the discipline here as Yassine said, it's been mathematically metered. And actually, we did a Bitcoin brainstorm with miners, and I think Yassine's going to tee that up in a minute. But this monetary policy basically was written in 5 lines of code. I did not know that until we did that Bitcoin brainstorm. It is so elegant, so simple, so straightforward. So in contrast, take a look at this. All right, this is M2's M2 growth, and it's a 4-year annualized percent change. So from March this month to March, or this past March to March 4 years ago, what is the monetary growth rate at an annual rate? That would be the last data point here, which is, you can see the black dash line. So that rate is about 8%. And actually, probably it's closer to 6%. There's a lot of data on this chart. But take a look at the 4-year growth rate of M2, and you can see it's all over the place. You can see in the 60s and 70s, it moved toward double digits, and we ended up with double-digit inflation in the late 70s, early 80s. It took a while to get there, and it seemed to be very sticky. And then after Chairman Volcker came onto the scene, I think that was 1979, he said, we have to get this thing under control. And he started choking money supply. And that momentum actually continued into the mid-90s. And then in the mid-90s, it was very interesting because it's somewhat similar to today. In the mid-90s, there was a domino effect of currency devaluations around the world. Our monetary policy was propagating throughout the world because it is the world's reserve asset. And the first devaluation actually was Mexico. And it was a big one. I remember it very clearly because we were involved with Mexican stocks. And then a few years later, we had the Asian domino effect. I think the Thai baht devalued in 1997. And then the rest of Asia's currencies devalued. We had the Russian default in 1998, and then we had long-term capital falling apart. Monetary policy propagates through the system, and when it's so unpredictable, it leads to all kinds of excesses. And so what do we have now, where we see what happened because of COVID? That drove the 4-year annualized growth in M2 up to 12%. And then now we've had a very sharp deceleration, unlike the 70s, 60s and 70s, where there was sort of an acceleration, at least in the sense of a trend, and a stabilization near double digits. Here we had money thrown at the system to prevent an outright depression. And if by the end of the year we stabilize around 0% year-over-year growth, that's year-over-year, this line will drop toward 2 to 3%, which, as you can see, we've only seen once. It was in the 90s. And, after that, all hell broke loose around the world. It is interesting to note that the devaluations, there are many devaluations taking place in the rest of the world today. I've mentioned in the past Egypt, I think, devalued by 40% in February or March. The Nigerian naira is down 50 to 60% in the last 9 months. We're seeing the Indonesian rupiah devaluing at an accelerated rate. And in Latin America, of course, Argentina basically recognized that the black market had it right, that its currency, at least publicly stated, was about 50% of that rate in the black market, and that was correct. So we're in a very interesting environment, and it's caused by monetary instability around the world. And so I often talk to Yassine about these devaluations, and of course, in emerging markets, anyone with a connection to the internet now pretty much can establish or buy an insurance policy in the form of Bitcoin, which, just flipping back to the halving in this purple line, doesn't look anything like the volatility you see in monetary policy here in the United States and around the world. And of course, it's controlled by human beings. When we went off the gold exchange standard and closed the gold window in the United States in 1971, monetary policy just became unhinged, and it has been unhinged ever since, although human beings have tried to contain the inflationary ramifications, and they take it too far both ways. And right now, we think they're taking it too far on the downside. And I'll get into that as we go through some of the rest of the monetary indicators and the economic and market indicators. It is amazing to me that Chairman Powell and the Fed governors, as you mentioned, there are no Fed governors here in the Bitcoin ecosystem, but there are in the United States. And every time one of them speaks, markets move. And you know what? As I said, they overdo it one way, then they overdo it the other way. And it's just contributing to a lot of instability, not only in the markets, but also in the economy, I would submit.
Wood draws parallels between the current economic climate and historical events, such as the currency devaluations of the 1990s. She discusses how Chairman Volcker's actions in the late 1970s aimed to control inflation by tightening money supply, leading to a period of stabilization. However, she warns against the unpredictable nature of monetary policy, citing examples like the Asian financial crisis and the Russian default of 1998. The onset of the COVID-19 pandemic prompted unprecedented monetary intervention, with central banks injecting liquidity to prevent an economic collapse. Wood explains how this led to a sharp increase in the growth rate of money supply, followed by a subsequent deceleration. She contrasts this with previous inflationary periods, highlighting the potential implications of stabilizing money supply growth. Wood discusses the ripple effects of monetary instability across the globe, citing recent devaluations in countries like Egypt, Nigeria, and Indonesia. She emphasizes the role of Bitcoin as a hedge against currency devaluation, contrasting its stability with the volatility of traditional monetary policies controlled by human decision-making.
Go through the drill. We've been through this month to month for a while now. And here you see M2, money supply growth versus CPI. You see money supply, the purple line there, is still negative, but not as negative as it was. That's interesting. You can also see that the CPI is kind of stuck in the 3 to 3.5% rate right now, or at a 3 to 3.5% rate. And what we think is going on right now is that companies are seeing their unit volume growth disappointing. And so they're trying to make it up with pricing. And in doing so, they're actually turning the consumer off more. It's not working. And I'll show you some indicators a little later on to that effect. So we think that they will be forced to take their inflation rates down if they want to invite the consumer back into buying products and services. So we think that this will resolve to the downside. It's been in a range now for, it looks like nearly a year in this 3 to 3.5% range. And if you look at the underlying economy, we're seeing the consumer starting to give way. We've seen it in different ways, housing related, auto related, but now we're talking about restaurants, which certainly have had a strong period as fiscal stimulus was burgeoning, but that's over now. And we do think the inflation rate is going to look a little bit like the money growth rate. We've been saying that we think it will turn negative at some point, and we still do. The biggest lagging indicator in the CPI is rent, and we're seeing signs of rental prices coming down. Actually negative in many parts of the United States. And so that alone will start pulling this down. We're seeing auto prices coming down as well as dealers try and move those units. Tesla's well advertised price cuts, maybe leading the charge, so to speak there. So we think that we do not think inflation is going to stay at this level. We think it is going to resolve to the downside in the next few months.
Expressing concerns about the Federal Reserve's handling of monetary policy, Wood critiques the tendency for central bankers to overreact, leading to market volatility and economic uncertainty. She analyzes the relationship between money supply growth and consumer price inflation, pointing to signs of pricing pressure amid disappointing unit volume growth. Wood predicts a potential downturn in inflation rates based on emerging economic indicators, such as declining rental prices and auto costs. She anticipates a resolution to the downside in the coming months, driven by factors like consumer behavior and market dynamics. Drawing on her expertise, she offers insights into the interconnected nature of monetary policy, inflation, and economic performance. Please like and subscribe my channel.